Well, welcome to chapter 21, where we talk about accounting changes and errors and what to do in the various situations. So sometimes accounting changes occur for various reasons. It could be a new method as mandated by GAAP, so the generally accepted accounting principles, where they require changes to how you approach situations. Sometimes it has to do with changing economic conditions, which have an impact on your estimates. Sometimes it has to do with changes in technology, different technology available. Maybe you have more accurate information in your fingertips are available. It could be changes in your operations that have a substantial impact in what policies you put in place. And sometimes you find that you just made a mistake, and so you need to make a correction when those errors are discovered. You can't just continue to hold and cover it. So we group those into three types of accounting changes. So these three types, it could be a change in accounting policy, a change in accounting estimate, or a correction of errors found as a result of reviewing prior periods. So we're going to walk through those different types of changes. So the first one we talk about change in accounting policy. Sometimes you can choose between what principles or practices under accounting that you apply in your entity. And from time to time, management might make a better decision to more accurately reflect their entity and what policy they adopt. Maybe it's to, they have better information, maybe it's to be more comparable to their competitors, et cetera. So they might adopt a new accounting policy from time to time. Sometimes the policy is required by an update to IFRS, so the standards that are internationally instilled upon us. So sometimes the change in accounting policy is required to be implemented. Under IFRS, they only permit a change when the change is required by a primary source of GAAP. So only when it's required are you allowed to change your accounting policy. If the change is voluntary, okay, so sometimes they'll put out new standards that are directives or frameworks, I should say, and it's a voluntary change. But if it results in a more reliable, more relevant, more comparable result, then you are expected to implement that change. ASPE is very similar to IFRS, but it also allows changes if, it allows changes without the reliable, more relevant test in some situations. So again, you can just make the decision if it's, is better suited to your entity and your organization under ASPE. Moving on to changes in accounting estimates. Sometimes an example might be you've revised your estimates of your assets or liabilities. So maybe you have carrying amounts of, say, a pension liability or an allowance for doubtful accounts, or the net or sort of fair market value of some asset or liability they have on your books. And maybe that's because you've done an assessment of the present status, or you had better information from your actuarial accountants on what those future benefits or obligations are. Some examples, I mentioned a couple already, but when you're looking at bad debt provisions, your allowance for doubtful accounts, looking at your depreciation estimates, so maybe you have a better residual value, maybe you have a different useful life, maybe you have a different number of units that a machine can produce, so it affects depreciation. We could talk about warranty costs and how you've amortized maybe unearned warranty revenue or estimated warranty liability. Sometimes it's around fair value of financial assets or liabilities, and maybe it's obsolete inventory, just as some examples. If you have a situation where it's uncertain whether it's a change in policy or estimate, you always consider it to be a change in estimate. So if you're like, is it really a change in policy? Perhaps not. If you're uncertain, you would classify it as a change in accounting estimate. The third and final category of accounting changes has to do with correction of prior period errors. So sometimes you make a mistake or provide inappropriate information that maybe, hopefully not on purpose, but if it was on purpose, maybe it's by somebody that's left the organization and somebody came in and found the error. So maybe there's a mistake in your financial statements, and that could be in one or many periods. And so you need to, once you've identified those mistakes, you need to differentiate between errors or changes in estimates. So it's one thing to change your estimates, it's another thing to make an error. So if you're reviewing your books and maybe your policy didn't change, but you find that a journal was posted incorrectly, you would consider that a prior period error. So examples of errors, maybe you've calculated depreciation to be $100,000 and your accountant recorded it at $10,000 by mistake, or your bookkeeper did, and you processed your financial statements, published it. After the fact, you realize, oh shoot, we reported the wrong amounts, and that would be considered a prior period error that would require adjusting. Okay, then once we've identified the type of error or accounting change that needs to be done, there are two approaches. Retrospective, otherwise known as retroactively, which means you need to restate prior periods affected by that error. So any published statements would be republished with the revised information. Under prospective, it means it's only you do the journal entries today and forward, so you move it forward. Okay, so any catch-up entry is done in the current year. The accounting standards dictate that a change in accounting policy. Okay, so we use the approach required in the transitional provision. So if it's an accounting policy change, they will state in that policy how you need to apply, whether it's retro or prospective. If it does not tell you which one to use, you need to use retrospective if it's practical. So if it's impractical to go back and reevaluate and repost and republish, then you could argue that you'll just do it prospectively. So there's a little bit of room for management discretion there if it's not stated in the accounting policy. If it's a voluntary accounting policy, use retrospective if practical, and otherwise just move forward using prospectively. If it's a change in accounting estimate, you apply prospectively, so today and moving forward. So you've changed the useful life of an asset, you changed your way your warranty, revenues earned, etc. You would just start today and move forward. And lastly, correction of error, you need to do retrospective. So you would restate any financial statement information that's been published to date. So how do you account for it? The journal entries on how to correct. So an accounting entry is made to recognize the effects of any new accounting policy. Okay, so when you're posting retrospectively, you need to remember to include any tax effects. Okay. So say the tax was, 30% corporate tax rate last year at $100,000 error, up or down, the $70,000 is the net $100,000. Let's use the $30,000, 30% tax recovery or tax expense, and you need to consider that as part of your journal. Your prior period of your comparative financial statements are restated, including any opening balances and equities. So say you have a 2-year financial statement, you would actually have to go back to 3 years ago, determine what that closing balance should have been, and then roll forward and restate the 2 years of activities in order to make sure that all your published financials currently reflect that correction. You would also then include a description of the change in the notes. So you'll have a note section to your audited financial statements that explains the change that was made and what's the effect on both current and prior periods. So you would spell out the impact. So when there's an error, you have to go retroactive. Okay. ASPE only allows a full retrospective restatement. So you have to affect every year that's impacted and displayed. IFRS allows partial if it's impractical to do full. So maybe you don't know all the moving parts, but you know some, you would apply as much as you could. Material errors must be corrected in the reporting year that they're discovered. So if you find an error now and it's material, you need to report it now and correct it accordingly now. You can't hold it for future years. Any correction is recorded as an adjustment to beginning balance of retained earnings. So you would restate your opening retained earnings, assuming that that error was never made. And then, as I said before, if they're comparative, those prior periods must be restated as well, just to make it look like it never happened. And don't forget, any prior period adjustments will impact both the net income including income tax and retained earnings. And on the statement of retained earnings, an adjustment may show as, will show as a correction of prior period error, and you can include a little, explanation. Maybe you put in brackets, amortization error, or bonus accrual error, or whatever that might be, warranty revenue adjustment. And then on the correction of error disclosure, you need to disclose in your notes as well, what's the nature of error, what was the amount of correction to each of the financial statement items. You would identify, it impacted warranty liability and the surplus for the year and maybe retained earnings or income tax payable. So you would indicate what those are. And you would also talk about the impact on the earnings per share, if applicable. And the amount of the correction made at the beginning of the earliest prior period presented. So you would say you had 2 years presented, you would go back and say, from say 2021 and prior, the cumulative error was $100,000, and maybe it was $50,000 each year for the 2 years presented. So you need to specify those specifically. And that's kind of the crux of errors and changes.